If you're someone who wants to beat the gold market but still struggles with timing your entries and exits, or haven't found a system that can consistently win, today I have a technique that's simple and clear. Most importantly, it's backed by 3 full years of statistics, with test results showing profits as high as $17,500, and you can do it too. This technique is called the Amazon Zone, and it will help you find entry and exit points that give you an edge over most people in the market. As always, you don't have to take my word for it, just trust the statistics. So, let's take a look. I've been testing this system from 2022 up until now in 2025, and then we'll come back to dive deeper into the trading method itself and cheap kind fights. And if you enjoy videos like this, don't forget to like, share, and hit the notification bell so you won't miss out on great videos in the next episodes. I tested this system on the gold chart using the 4-hour time frame, on the Tickmill broker's chart, a broker with a top-tier Forex license. So, in terms of safety, low spreads, low commissions, and fast deposits and withdrawals, it's all excellent. Personally, I mainly use Tickmill broker for my trading. The results of the system are quite interesting. The win rate is as high as 63.33% with a total of 60 trades, 38 wins and 22 losses. I used a risk per trade of 5% with a capital of $10,000. So when I hit a stop loss, I only lose $500. But if I achieve an RR of 1.5 times, I gain $750, which helps recover any losses. You can see that this system can generate a profit of up to $17,500 or 175% even amidst the drawdowns. The maximum drawdown is only 20%. So, I consider this a very interesting and easy to follow system, and everyone can definitely replicate it. Now, let's take a look at some trading examples, both in uptrends and downtrends. Today, I have good news for traders who already have an account with Tickmill Broker or are considering opening a champion account. Trade School has partnered with Tickmill Broker to launch a high-quality trading signal room, AI Master Signal, which you can use for free. Signals are sent in real time, covering both the gold and Forex markets using the latest version of AI. It has been tested in real markets for over 5 years, generating a total profit of more than 1,000%. Joining is easy. Open an account with Tickmill Broker using the link below, deposit $700, fill out the form to join the signal room, and wait for the team to verify your information. You'll be invited to the room after verification. Don't miss out. Golden opportunities like this are rare. AI Master Signal is the trading assistant of the future, and you can access it free. Let's first look at how to set the parameters correctly. We will use a total of 3 EMAs, and for all 3, when creating the channel, we will use the same period, which is 100. For the first line, the period is 100, but what differs is the source used for the calculation. I will use EMA 100 with the source set to close for the first line. For the next line, it's also EMA 100, but the source is set to high. And for the last line, it's EMA 100 as well, but the source is set to low. If you set it up correctly, you'll get a channel that looks like this. Next, we'll look at how to find an advantageous entry for trading. Now, let's take a look at an example of an uptrend. As you all know, the technique we're using today involves treating the EMA as a zone. Let me clarify first which parts I'll refer to as the upper zone and the lower zone. Take a look here, there's a gap between the upper line and the middle line. I'll call this the upper zone. That way, when I explain the technique, you'll understand what I mean by the upper zone. So the area from the upper line down to the middle line, this strip here, is what we call the upper zone. The next zone is the lower zone. It's not complicated. It's simply the area from the middle line down to the lower line of the channel. This is what we call the lower zone. So when we study this technique, you'll understand that there are just the upper zone and the lower zone in this EMA channel. Now, for the first condition, in an uptrend, I will wait for a candlestick that breaks out and moves away from the EMA channel zone. On the upper side, it means breaking out from the very top line. The term breaks away, those who have been following me for a while probably know what I mean. It refers to a candlestick that breaks away because its low does not touch the upper EMA, the upper channel line here. See, nice one, my guess. This is the first candlestick, so count it if there are 2 candlesticks that break away. Now, this candlestick does not break away. What does that mean? We have to start counting the steps again, or look at the next candlestick. Let's go slowly. This one breaks away, right? Why? Because there is no low that touches or makes contact with the upper zone here at all. Next, this one also breaks away, so that's another candlestick. Therefore, right here, this is the end of this part. This counts as the completion of the first step, the first and second candlesticks. The trend here is now confirmed as an uptrend. For the second part, listen carefully. I will wait for a pullback to where? Or to this lower zone right here. It can just touch or even close in this area. But the important thing is that the pullback must not close below the EMA in this lower zone, or in other words, below the lower line. Absolutely not. If that happens, you have to start counting the steps all over again. Let's see. I'm sure you're starting to understand and can still follow me. Right now, the chart is still waiting above, so we're not doing anything yet. What will I do next? Only when it comes to touch this lower zone. Right here, nothing has happened yet, so just let it be. Which candlestick is it that touches the lower zone? It's this candlestick right here. Notice how its wick actually dips into the zone, the lower zone. You can see that the pullback goes deep into the lower zone, but what? It doesn't close below this line. So this is okay for step 2. We've already encountered step 2. Now, you should look for a bullish candlestick handle. 3, it can close above the flat EMA on top. The upper EMA, the very top line. Here it comes, see? And the closing price, what about it? It hasn't broken out of this zone, right? And it closes right here. This is step 3. Why is that? Because the closing price is higher than the very top EMA line. This shows that there is already buying pressure and a high chance for the price to continue upward. So you can enter a trade here in step 4. Place your order at the closing price and listen carefully about the stop loss. Set it at the very bottom EMA line, at 1.5 times the distance. Calculate your risk carefully. Many people are blowing up their portfolios these days, especially in crypto. So be very careful. Going all in without a stop loss is extremely dangerous. That's one trade done. The profit's already in. Was it easy? Super easy. Next, let's take a look. It's the same pattern as before. First, wait for the breakout and for it to drop below by at least 2 candles. You can see here, there's candle 1 and candle 2. So step 1 is done. So next, we might need to wait for a pullback into the zone, the lower zone. You'll notice that it already came back starting from this red candle here, returning to the lower zone. The next candle also enters the zone again, but we have to watch and make sure it doesn't close below the lower EMA, low here. If it closes lower, we don't count it. But in this case, what happened? There was actually a bullish candle that bought back up. So the momentum for the price able to continue moving is very high here. It's already entered the zone. Therefore, we can open an order right here and place the stop loss here. CP, right? Moving on here, there was a pullback, but only to the upper zone, not down to the lower zone. So we just stay calm and watch this shot. After the pullback, what happened? It entered which zone? The lower zone right here. See? The lower zone right here. But it still didn't close below it either. So at this point, we still need to monitor it. It's still within the conditions for us to consider entering a trade. And then there's this candle, which closed higher, starting from this candle. When it closes above the upper EMA, or like this, we can enter a trade again. Open a buy at the closing price, set the HL, and place it at the lowest EMA line. Here, we take profit for another round. See? The key point to note is that there hasn't been a breakout here yet. There are 2 candles, right? So in this case, we still don't take any action. I hope that's clear. A simple example is to look for a breakout. 2 candles, then a pullback, back into the zone below in the case of an uptrend. Then the bar we take action on is the one that closes above that level. Here, it's the same. There's a breakout, several candles go up, then it pulls back down into this zone. So look for a bullish candle and then open a position as it moves up. Basically, we're just following the trend. There's nothing complicated about it. This should be an example of a downtrend setup. Let's take a look at a downtrend setup together. First, there needs to be a breakout, but this time to the downside with at least 2 candles. As I can see right now, there's this candle that breaks out. See how its high doesn't touch the EMA? That shows there's a fair amount of selling pressure. There are 1, 2, 3, 4 candles. See? So I'll wait for it to pull back. Wait for it to go back up to the upper zone. This area here is the upper zone. Once it reaches the upper zone, If there's selling pressure that pushes the price back down to close lower, then we make a sell entry. That's our plan. But as before, it must not close higher here. It doesn't close higher. And the next bar, this candle, is very important because it closes even lower than the EMA line. So right here, we can go ahead and sell a HL. On the other hand, set it at the upper EMA with a risk-reward ratio of 1.5, just like with the upward trend. Here we've taken another order, closing it along the way. You'll notice that there's a retracement upward, and then what happens? It goes up to the upper band zone again, and then does it break away first or not? You have to check this as well. And did it break here? 1, 2, 3. See? It didn't touch the EMA area at all here. It didn't hit the lower EMA line at all. So this one has broken away at least. It broke out upwards in 2 directions, and then there was a pullback right up to our upper zone. After that, what happened? There was selling pressure at this candle. See? The closing price closed below the lower EMA. So here, we can stack another position. I only allow stacking 1 more position, no more than that. Place the stop loss above and set the risk-reward ratio at 1.5. This position is also closed out here. See? The first position is closed, and the second one is closed at a take-profit area that's very close by. It's not difficult, whether it's an uptrend or a downtrend. But just make sure to pay close attention to the zones. Alright, let's look at the next example. This is still a downtrend. Here, the price has broken away for quite a few candles already. You'll notice right here, there's a pullback upward. It broke away and then pulled back up to the upper zone. But do you see where the closing price is? Why? The closing price here is higher than what? The upper EMA. I've already said, in this case, what should you do? Avoid trading. Because if you do trade, what will happen? Let's take a look. This candle also drops down just as expected, right? It closes below the EMA low. So let's say we sell here, just as an example. But in reality, can we actually sell? No, we can't. Because I've already said that the key condition is that the close must not be higher than the upper EMA in a downtrend. But let's suppose you went ahead and sold anyway, setting your risk reward at 1.5 times. Let's see what happens after you sell. It shoots to the moon, right? That's it. Straight to the stop loss, just like that. See? This is a warning. When the price closes above the upper EMA like this, the setup is no longer good. This kind of setup isn't good, so we won't trade it, okay? Then we skip trading here, I've shown you examples of everything, both the profitable trades and the situations you need to be cautious about. Don't just skim through or you'll miss the important points. If you don't watch the video all the way through, you won't get it. You might miss this example right here. So for every one of my videos, make sure you watch every minute because there are important details throughout. I hope you all like this technique. It's a special method that I've personally used to profit from gold trading over the past 3 years. The profits have been in the hundreds of %, just as you saw in the initial test results. So I encourage you to try it out and experiment before using it for real trading. If you get good results, don't forget to comment below and please like, share, and turn on notifications so you won't miss the next episode, which I guarantee will be even more exciting. That's all for today. See you again in the next episode. Goodbye.